Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, so let's just dive right in. We're looking at the epicenter of the global semiconductor battleground, which is, of course, Intel Corporation. The stock has seen just dramatic volatility, and it all culminated in this significant rally after the big strategic action that closed out 2025. And that rally was, of course, triggered by the core event we're here to dissect, the $5 billion strategic capital injection from NVIDIA in December. Now, this wasn't just a loan. NVIDIA took, about 4.4% of Intel's equity. And crucially, they did this at a fixed price of $23.28 per share. Now, when the deal actually closed, the stock was trading much higher, often into the mid-30s. But that $23.28 price, it acts as a kind of hard financial floor. It's a guaranteed exit, which just profoundly changes the whole risk profile here.
It does, and that floor is necessary because, as we're sitting here in early 2026, we have to recognize the sheer scale of the challenge. This is not a standard business cycle recovery. Intel is trying to pull off what is, maybe the most complex corporate turnaround in the history of the entire semiconductor industry. This whole effort, IDM 2.0, is now being steered by the new CEO, Lip-Bu Tan, who took over back in March of 25.
Right, which really frames our whole discussion today. So given this massive strategic backing, combined with what looks like a profoundly discounted valuation, is Intel now an asymmetric high-reward investment? Is the risk fundamentally taken off the table by these external guarantees?
See, I'm afraid I come at it from a completely different angle. For me, the question is whether these external factors can really overcome the internal rot. Is Intel a classic value trap? Is it burdened by the just seemingly insurmountable difficulty of catching TSMC and the relentless structural decline of its core x86 business?
I am convinced that the confluence of that strategic capital, government backing, which we can't forget, and this new leadership focused on operational streamlining, it creates a highly asymmetric opportunity for 2026. The downside feels contained, and the upside potential for a re-rating is just massive.
And I believe the company faces insurmountable structural challenges. The stock is cheap on its assets, sure, but I think it remains profoundly expensive when you measure it against the future reality of its profitability. It is, to me, a textbook value trap.
Let's look at the evidence for stabilization. The distress phase that really defined 2024, I think that's over. And we saw definitive proof of this in the Q3 2025 results. Revenue hit $13.7 billion, and more importantly, the non-GAAP EPS was 23 cents. Now that figure just dramatically beat consensus, which was hovering, near zero. And that's crucial. It shows that the fears of a catastrophic accelerating cash burn, those fears have been definitively addressed. The operational floor has been found. But the true asymmetric opportunity, it's rooted in valuation, specifically the book value thesis. Intel is trading at a price-to-book ratio of only 1.7 times. Just think about that. We are talking about the most sophisticated, expensive manufacturing facilities on the planet. The market is pricing these multi-billion-dollar fabs as if they're generating almost negative returns.
Now, you compare that 1.7x to its foundry peer, TSMC, which trades at 10.3x book. If the new management can get even a fraction of TSMC's capital efficiency, if they can get those assets working again, the potential for a re-rating is enormous. And look, the market technicals support this. Short interest is extremely low, barely above 2.5%. The big institutional bears, they've backed off, deterred by this so-called NVIDIA put and strong government interest.
That's a compelling case, but I just don't buy that the technicals reflect a long-term fundamental reality. Let's start with this idea that the NVIDIA deal is a seal of approval. Yes, it provided a huge liquidity and sentiment boost, but its purpose is highly practical and, frankly, self-interested for NVIDIA. It's about supply chain hedging. It's about mitigating the CoWoS bottleneck. CoWoS, for anyone who doesn't know, is that critical advanced packaging tech for connecting NVIDIA's GPUs to memory. And it's a severe capacity constraint right now. NVIDIA looks at Intel and sees a utility provider, a necessary backup source of U.S. domestic packaging capacity. It is a hedge against geopolitical risk, not a high-confidence vote in Intel's ability to drive 30% gross margins in 5 years. And let's talk about the valuation from the earnings side. You're championing the price-to-book gap, but we have to look at future earnings. At roughly 56 times forward PE, Intel looks shockingly expensive. I mean, especially compared to a high-growth company like NVIDIA, which trades around 25 times. That 56 multiple is a massive PE distortion. Investors are paying a premium today for a highly uncertain, distant recovery that might never happen. This isn't cheap. And furthermore, the fundamental issue isn't the price of the assets. It's who is going to buy what those assets produce. The structural decline of the x86 monopoly, that's the real cancer here. You've got client erosion from Apple's M series, the whole Windows on ARM movement, and critically, cloud migration hyperscalers like AWS and Microsoft designing their own silicon like Graviton and Axion. That is going to structurally reduce Intel's highest margin server revenue, regardless of how well their manufacturing does.
I understand why you focus on the x86 decline, but I believe that pessimistic view severely underestimates the strategic depth of this NVIDIA partnership. This $5 billion commitment, it's more than just geopolitical hedging. It's a profound strategic endorsement. It's the first time Intel is openly validated as a core part of the future distributed silicon supply chain. By securing future access to Intel's advanced packaging, Foveros, and EMIB, NVIDIA is moving beyond just a transactional relationship into a kind of strategic co-opetition. So this isn't just about utility work. This partnership reduces the existential risk, and it provides a clear runway for Intel Foundry Services to go court other major customers, using this as a huge proof point. You're treating the $5 billion as just operational cash. I see it as collateral for future high-value manufacturing partnerships.
I agree that it removes the existential threat. But let me push back on that high-value argument. The deal fundamentally validates Intel's IDM 2.0 only as a contract manufacturer. It guarantees Intel gets the utility work packaging NVIDIA chips, but packaging isn't the same as high-margin process innovation. The critical risk here is that Intel Foundry just becomes a low-margin subcontractor for NVIDIA's overflow, rather than a self-sufficient foundry that dictates its own terms. For the foundry to actually succeed and get industry-standard margins, it needs to land that mega-whale external customer, someone to commit huge volumes to the 18A node. Just providing packaging access, while vital, it doesn't erase years of distrust from fabless customers who doubt Intel can actually execute on time. And that leads directly to the core of the bear case: execution risk.
We can't just look past Intel's decade-long history of, well, significant roadmap failures, whether it was the repeated delays of 10 nanometer or the struggles with 7 nanometer. The bear case is leveraged entirely on the potential catastrophic failure of the 18A process node to achieve parity with TSMC's N2, their 2-nanometer equivalent, on time and to fail to secure that critical external customer. The bears out there, they view the management goal of breaking even by 2027 as wildly optimistic, specifically because they don't trust the institutional ability to manage the 18A ramp without the same missteps that plagued the last decade.
I'm just not convinced by that line of reasoning. It focuses entirely on history while ignoring the massive governance transformation that's happening right now. We are talking about a fundamentally different organization under new leadership. The appointment of Lip-Bu Tan in March 25 was a decisive external pivot. It replaced the previous era of, let's call it, visionary ambition marred by capital inefficiency with a ruthless focus on external expertise and rigorous financial discipline. Tan's background is crucial here. He comes from the EDA world and venture capital. He knows the fabless customer ecosystem inside and out. The new strategy is about right-sizing capacity and imposing CapEx discipline, a sharp contrast to the old build-out mentality. The removal of the old guard, the injection of fresh DNA, it all signals a genuine culture shift. The turnaround isn't predicated on physics getting easier. It's predicated on institutional decision-making getting smarter.
A change in leadership is absolutely a positive catalyst, I'll grant you that, but the burden of proof is immense. You're basically arguing that a new CEO, however scaled, can instantaneously erase a decade of deep-seated institutional failures in a market where the manufacturing gap between Intel and TSMC is wider than it's ever been. The technology is zero-sum. Either 18A hits yield and performance targets on schedule, or the entire foundry services business model is fundamentally impaired. We shouldn't discount the possibility that this new disciplined approach, it just comes too late to change the technological facts on the ground.
But you continue to argue that the business is failing, while my whole thesis is that the current stock price already discounts catastrophic failure. Let's go back to that valuation disconnect. The 1.7 price-to-book ratio is the inherent safety net. That massive asset base, the factories, the equipment, that is the intrinsic value. It is the prize if Lit Bhutan can simply drive those assets to even a fraction of TSMC's efficiency. And institutional positioning is telling. We're seeing significant money moving into long-term equity anticipation securities, or LEAPs, with strikes well above $50. This signals that smart money is betting on a multi-year recovery. They're positioning for the eventual profitability of these assets, betting that the political imperative to have a domestic supply chain prevents them from becoming liabilities.
Respectfully, the PB metric you're championing, it precisely highlights the systemic problem, not the hidden opportunity. TSMC's 10.3 ratio isn't arbitrary. It's earned through unmatched execution, high margins, and a stable customer base. Intel's low PB reflects the market's deep-seated expectation that the efficiency gap will persist because of chronic underutilization and high operational complexity. I mean, just look at the market cap disparity. Intel is sitting around $188 billion, while its main competitor, AMD, which has successfully eaten Intel's server market share with EPYC, trades at over $280 billion. That disparity reflects profitable execution on one side and continuous, high-margin market share erosion on the other. Unless Intel can stop the bleeding in its core businesses, the assets you cite as inherent value might truly become a massive, subsidized money pit that just requires constant, low-return capex to stay relevant. So, in summary, while I absolutely acknowledge the very powerful external safety net, the government support, the NVIDIA deal, and the low short interest, the fundamental structural risks, they remain the ultimate deciding factors. The erosion of the x86 architecture and the critical zero-sum execution challenge of the 18A node will determine whether Intel is a recovery story or, as I suspect, a long-term value trap. The investment is fundamentally a bet on an extremely high-stakes technological and operational gamble.
I completely agree. The outcome absolutely hinges on execution. But the critical difference today versus 2 years ago is the market has provided a significant safety margin. The NVIDIA deal, which established that hard price floor, combined with the extreme valuation asymmetry, trading at 1.7 times book, it provides a profoundly favorable risk-reward balance. If the new leadership can deliver on the successful ramp of 18A with the Panther Lake client processor launch in 2026, the potential for a swift re-rating toward industry norms makes the current price an undeniable asymmetric opportunity. These assets are simply too large and too central to global strategic policy to be allowed to fail. Ultimately, Intel remains a fascinating, high-risk, high-reward special situation. It's one of the most compelling strategic plays in the market today.
Absolutely. And for listeners trying to form their own verdict, the complexity here means that tracking the key watch items for 2026 will be crucial. Specifically, tangible 18A external customer wins, beyond government contracts, and any formal move toward a financial separation of the foundry business. That's what will be absolutely critical for gauging the sustainability of this turnaround. There is clearly significant nuance still to explore.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.